So another week and another what is this? Another outperformance by the couch investing portfolio. We were actually up 0.15% for the week. S&P 500 was down 1.46%. At the start of the week, the portfolio was actually up 3.16% compared to the S&P 500 being up 0.17%. So quite a big difference there. But overall, now the returns are back negative 2.77%. During that start of the week, we were actually up on the initial investment. But I mean, if you look at the holdings that I currently have, you can understand why this is in the short term a roller coaster ride. Because the, let's say, top 5 positions are quite volatile-ish in recent weeks, especially with Tesla. PayPal, recently not that much. It's been a bit boring, but boring on the way up. Google has outperformed, which I love. I'm up now 13% on that position. PayPal, we're up 10% there. With regards to Tesla, we're down 5% currently. Wouldn't surprise me if we go down even further after the earnings call. Of course, it depends on what gets mentioned during that call. SoFi down 4.6%, and then to close the top 5 off, Adobe down 8.58%. Now, I do have a couple of things that I want to mention in this video with regards to Adobe, with regards to Apple, Rocket Lab, and then of course, Tesla. I'll first start off with Tesla since I know a lot of my viewers are Tesla shareholders. And since last week was a pretty big week, I mean, every week is a week where everything changes for Tesla. It's been a roller coaster of a ride. So yeah, let's get started with Tesla, with the impact of FSD, some speculation as well. Of course, do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if not. We're very, very close to reaching 40,000 subscribers. So I appreciate all of you very, very much. Of course, with regards to Tesla, we just did a test. There's no we. I just did a Tesla weekly video, which comes out every week on Saturday. If you missed that, all of the other numbers are in that video. But now let's talk about FSD, the subscription, right? Because the announcements came, of course, Friday, because why not? So now instead of paying $199 a month, you are paying $99 a month in the US and Canada. Now, currently, the US FSD capable fleet is 2 million vehicles. The Tesla fleet overall is 6 million vehicles. Now, I already added here what could happen if suddenly there is FSD in China. This is just a what if. So same metrics here, but FSD is much cheaper. In my opinion, could even be lower than $50, than $40. Remains to be seen. Again, these are just assumptions. Right here, what you're seeing is the consensus for revenue this year. So revenue is only expected to grow 4.45% year over year. Net income is expected to be down close to 10% year over year, and gross profit to grow 8.39% year over year. With regards to valuation, currently, this is the state of Tesla. So forward PE 61.6 times, EV to sales 5 times, EV to EBITDA 33 times. Now, for a company that is probably not going to see its EPS grow this year, it is quite expensive. Quick correction here, I said before revenue would increase 4.45% and gross profit 8.39%, but it was a mistake, actually the opposite. Revenue should increase, that's the expectations, by 8.39% and gross profit by 4.45%. Apologies for that mistake. Now, with regards to the analyst estimates, EPS for fiscal year 2024, expectations of it to be down 11%. That number might actually increase, meaning more red. But then going into fiscal year 25 and 26, you see a big reacceleration in growth with regards to EPS and sales as well. Now, going back to the FSD numbers, which you can see right here, I give it a margin of 80%, which are software margins. You might say it's a bit higher, it's a bit lower. You can play around with that yourself, take a screenshot and just copy everything. So Tesla fleet, 6 million, US FSD capable, 2 million, FSD per month, $99 per month with a 20% take rate. Some people say higher, some people say lower. I pick 20, but you will see soon enough we can change that pretty quickly. So that means $118.8 million in revenue each and every quarter, and per year close to $500 million. $500 million a year in revenue. 80% margin, reaching $380.16 million. Then if we do the same for China, but in China, the FSD per month cost $49, 20% take rate, you'll reach $58.8 million in revenue per quarter and $235.2 million per year. If you combine both of those, that's $710.4 million per year from the FSD subscription with an 80% margin, just under $600 million of profit. Now, of course, as the fleet grows, so let's say it grows to 4 million in the United States and in China over, I don't know how long, a couple of years, I would assume, because every year we're producing and delivering around 2 million cars. Let's say we don't grow, worst case scenario, it's always 2 million. So yeah, eventually in a couple of years, you're going to reach 4 million in the United States, 4 million in China, same take rate, same price, although those things will change in the future, right? Take rate might suddenly be 15%, or take rate might be 25 or even 30%. Of course, the higher the take rate, the more money they're going to make. But let's stay conservative. Let's say with 20%, 4 million, which also means, by the way, that the fleet has grown as well to around 15 million or so, because again, this is just US and China. You still have Latin America, you have India, you have Europe, etc., etc. So let's put 4 million here, 4 million in China, 20% take rate. So now you're generating $237.6 million in revenue per quarter, close to $1 billion a year in the United States. For China, we're basically getting a bit of the same numbers the US got before. So revenue, $117.6 million, revenue per year, $470.4 million. You combine both of those areas, you get $1.42 billion in revenue each and every year, which is $1.13 billion in profit. And that's just from FSD, just from those numbers. Recurring revenue, of course, there's going to be churn, but I mean, this is not that bad, right? $1.13 billion, pretty conservative numbers, pretty low numbers as well. And these are recurring revenue. Wall Street loves that. And of course, you're also going to get Europe, other countries, maybe even more cars, better pricing, meaning for Tesla and for the consumer, because I assume that if you have a professional fleet, you're probably going to pay a bit more. In my opinion, that's also why there still is that option of $12,000, because right now it doesn't make any sense. If you choose the subscription, it will take you 12 years until you reach $12,000. Who knows what might happen in those 12 years, right? So why pay $12,000 right now up front? Of course, it's great for Tesla to get that $12,000 already in, but you as a consumer, just doesn't make sense anymore. And I'm not even talking about the $6,000 of enhanced autopilot. That never made sense to me. Now for the ultra bullish scenario, let's say the take rate is 50% for both United States and China, then you're generating $3.55 billion in revenue a year and $2.84 billion in profits each and every year as well. By the way, if the margins are higher, the profits will be higher as well. But this again shows you the effect of a $99 per month and a $49 per month FSD subscription. Now, why am I showing you this? I'm showing you this because Wall Street doesn't really care what happens in 5-10 years from now. Well, most people on Wall Street don't really care. They care about what happens in the next 6 to 12 months. And as I've just shown you, in the next 6 to 12 months, no matter how bullish the scenario will be, you're not really going to move the needle that much with regards to FSD subscription. So if you're surprised by the lack of reaction of that announcement of $99 per month, don't be, because it will not move the needle for Tesla in the short term. In the long term, for sure. But in the short term, I think the energy side of the business, services, will have a bigger impact in the next coming quarters. Then with regards to the valuation for Tesla, as we've seen, yes, it is a bit cheaper than the 5-year mean. But if you look at price earnings to growth, it's a bit higher than what you would like. It's now at 4.44. So that's it for the Tesla part of the video. If you've got enough, if you want to share some comments, let me know down in the comment section below. Now let's move over to Apple. Apple had a pretty strong-ish week, all things considered, right? A nice little rebound over that $170. So right now I'm only down 1.35%. As I said, I'm only using this position as a sort of extra cash position because of Apple's performance, share buybacks, and dividends. Now, with regards to Apple, we've got some news. By the way, this is on Seeking Alpha. You can get a discount. Link is down in the description below. You're helping me out and you're helping yourself out as well. So Apple now assembles 1 in 7 iPhones in India, accelerating push beyond China. I don't think the CCP will be happy to hear that news, but it's great news for Apple, especially moving forward. Who knows what the geopolitical situation will be there in the region. So they say here the California-based company now makes nearly 14% or about 1 in 7 of its iPhones in India. Of course, China remains Apple's largest iPhone making hub and the largest overseas market. However, the company's sales are declining in the region, impacted by rivals such as Huawei Technologies, which basically have stolen American tech, and an expanding scrutiny on the use of foreign technology in the workplace. And we've also heard that with regards to chips, Intel, AMD, and other chip makers have all been hit throughout the week. Sales of iPhone fell 4% year over year in February, with most of the decline concentrated in the United States, India, and China. Some more news came out. Apple to focus M4 chips on AI as tech giant looks to boost Mac sales. This is exactly what I told you all a couple of weeks ago. Same thing with Google when all the news that came out was bearish on Apple, was bearish on Google. I said, look, with regards to Apple, for sure they're going to market their next product launches as AI products, as AI devices. And with regards to Google, just the sentiment was horrible and it was a no-brainer because sooner rather than later, the market will realize that Google is a huge, huge player in the AI race. Now, with regards to Apple here, they say that the next version of the M series of chips, set to be known as the M4, not BMW M4, but the M4 chips for Apple, will come in 3 varieties. The M4 is already nearing production and will eventually be put into every Mac, with announcements to come as soon as this year. Of course, now that Apple is not focusing on the Apple car anymore, focusing more on what they are known for, which is good products and especially services as well, it's quite bullish for the stock. Then looking at valuation for Apple, since the business has not grown at all, stock is still up 10.8% year over year, although it's down 8.18% year to date. Forward PE is basically the same as the 5-year mean, but if you look at price to sales, a bit more expensive. And then EV to EBITDA, price to free cash flow, were again a bit higher, but not that much. Price earnings to growth 2.6, which is again higher than previously, but we've been higher before. For example, in 2021, 3.79. Not so long ago, at the end of 2023, we're at 3.5. Up next, quickly touching on Adobe. Like I said, I'm down 8.58% on that position. With regards to Adobe, there is pain because, well, it started because of OpenAI's Sora. Then the earnings report didn't get the guidance that the market was looking for, even though they were happy with that guidance 3 months before. So yeah, quite strange. And then again, could AI hurt Adobe's business? Yes or no? My bet is on no. I've shown you this picture in actually today's video, depending on when you're watching this video. I think AI will help a business like Adobe, business-wise, and of course for the consumer as well. Then more recently, this came out, Adobe buying videos to build text-to-video AI model. This comes as no surprise to me. They've been talking about that. They've been talking about quite a lot of things, translations, audio, etc., etc. So they say here, the tech giant is offering its network of photographers and artists $120 to submit videos of people carrying out everyday activities, such as walking or showing emotions such as joy and anger, among other things. The company, however, cautions against providing copyrighted material, nudity, or other offensive content. The aim is to get assets to train AI. We've talked about the importance of making sure that whatever you're using is licensed, that is not stolen content, that is not manipulated content, and that you can actually know where that content comes from, unlike the folks at OpenAI. Now, with regards to Adobe, we've talked about that also Sunday. So valuation-wise, it is becoming quite attractive, in my opinion. Much lower, not much lower, but it's lower than its 5-year mean. Forward PE, EV to EBITDA, price to sales, price to free cash flow in the last 12 months, and then price earnings to growth now at 1.57. In my opinion, it becomes very, very attractive. Then last thing I want to touch on is Rocket Lab. So Rocket Lab, I'm down 13.7%. The average here is at $4.32. I might actually buy a little more to make that average cost price come down a bit. Now with regards to Rocket Lab, same with Appcelera, these are long-term bets. Either they become multi-baggers or they become zeros, but at least they won't really have such a big negative effect on the overall performance of the portfolio. So with regards to Rocket Lab, we've had two positive news came out. So Rocket Lab secures $14.49 million task order by the US Space Force. Of course, overall, it's not that big of a contract, but hey, we'll take what we can get. The mission will be Rocket Lab's third for the US Space Force, further strengthening Electron's position as the leading small launch vehicle, delivering reliable and responsive launches for the Department of Defense. Then secondly, a contract that is double that size, so they secured a $32 million US Space Force Space System Command contract. Under the contract, Rocket Lab will design, build, launch, and operate a rendezvous proximity operation capable spacecraft. According to Rocket Lab, the mission was contracted under Rocket Lab National Security, a wholly owned subsidiary. The mission is targeted for launch in 2025. Now, Rocket Lab is still a very, very tiny company, right? Under $2 billion in market cap. Price to sales in the next 12 months, I believe, is still over 4 times. Yes, we know that the next milestone is going to be the test of Neutron, but I still believe that Electron right now as a business, plus they don't just do Electron, they do quite a lot of other things. There's a video about the whole Rocket Lab, plus a talk with me and Vince about Rocket Lab. They're basically trying to be that one-stop shop for all your space needs. And if we believe what analysts are expecting, by 2030, the space industry, the space business will be worth more than $8 trillion. So, I mean, it's a cool bet to make. Under $2 billion, risk-reward wise, I think for me was a no-brainer. I love space things, and of course, since you can't directly invest in SpaceX, I think this could be the next best thing. So overall, while obviously right now we're still underperforming by quite a lot, earnings season is around the corner. I expect more volatility in this portfolio. But again, I do still think that this portfolio is now very well positioned. I know it's very, very tech-based, high risk, high reward, blah, blah, blah. I know fully well what I own, and I'm pretty confident and comfortable owning those companies. So that will be it for this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.